Every bank requires a massive financial cushion, known as capital, to absorb losses and protect everyday depositors from ruin when the market drops. The safest way to build that cushion is by issuing stock, but relying entirely on equity is expensive, so banks often prefer to build their reserves using debt. This creates a paradox. Debt is money the bank owes. How can a regulatory body like the Federal Reserve classify a financial liability as a protective safety net? If a bank tries to use standard, everyday corporate debt as its cushion, the exact moment the economy dips, those payment obligations will drag the institution straight into bankruptcy. To qualify as protective capital, banks have to issue a highly specialized instrument called subordinated debt. Using this tool requires tossing out the normal playbook for borrowing money. For debt to successfully support a bank during a crisis, regulators have to strip away the legal rights and protections that lenders usually rely on. Let's put a hypothetical bank through a market crash. The economy takes a hit, cash tightens up, and the bank's balance sheet starts bleeding. The first Federal Reserve mechanism kicks in immediately, the rule of subordination. These specific investors are pushed to the very bottom of the structural queue. If the bank collapses and must be liquidated, everyday depositors and general creditors get paid first. The subordinated debt holders stand completely unsecured at the back of the line, ensuring their money absorbs the blow so others don't have to. A standard lender would never agree to sit patiently at the back of the line while a company burns. They would pull the ripcord. In standard finance, that ripcord is an acceleration clause. It's a contract provision allowing lenders to demand their entire principal back immediately at the first sign of trouble. The Federal Reserve strictly bans acceleration clauses for this tier of debt. The only time these investors can demand early repayment is if the bank is already in formal bankruptcy or receivership. Allowing lenders to yank millions of dollars out of a struggling institution would instantly drain its remaining liquidity, forcing an involuntary collapse. Regulators are effectively trapping the investor's money inside the burning building, ensuring the bank retains the resources it needs to put out the fire. Our bank survives the initial shock, but the damage results in a credit rating downgrade, sparking panic among investors. Often, lenders try to protect themselves against this risk using credit-sensitive features, also known as exploding rate debt, where the interest rate automatically spikes if the borrower's rating drops. This chart shows exactly why that is so dangerous. We have the bank's declining credit rating tracking downward, which automatically triggers the interest payment obligations, forcing that line to shoot exponentially upward. Those higher payments actively siphon away the exact cash reserves the bank desperately needs to conserve to stay afloat. Watch the cash reserves plummet to zero, mathematically ensuring a structural collapse. Because of this, the Federal Reserve explicitly forbids credit-sensitive features. A capital instrument has to stabilize a deteriorating institution, not bleed it dry. A true safety net cannot charge a premium exactly when the acrobat is falling. Because those investors were legally locked in place with fixed rates, our hypothetical bank navigates the downturn without running out of cash and survives. But at the end of the day, this is still borrowed money. To keep the balance sheet honest, the Federal Reserve caps the amount of subordinated debt a bank can count as its Tier 2 safety net to a maximum of 50% of its core capital. And even when economic skies clear, a bank cannot voluntarily pay off this debt before maturity. They have to get explicit, prior approval from the Federal Reserve. The regulators will only allow an early payout if they can calculate that the bank's overall capital position will remain highly secure without that cushion. Subordinated debt is a meticulously engineered regulatory tool. It exists to ensure that when a market crashes, wealthy debt investors absorb the shock, protecting everyday taxpayers from footing the bill.